Welcome to Mastering Your Financial Life, hosted by Judy Heft, the founder and CEO of Judy Heft and Associates, Financial and Lifestyle Concierge. This year, she's celebrating 27 years in business. In every episode, Judy interviews professionals who help others successfully manage their financial lives. You can find this show on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, Stitcher, and more. Judy is the author of 2 books, How to Be Smart, Successful, and Organized with Your Money for a Better Today and Tomorrow, and her latest book, Mastering Your Financial Life Cycles, How to Successfully Manage Money in Every Decade of Life. You can read chapters of her books and catch prior episodes of the show at www.judithheft.com. Now, here's the host of Mastering Your Financial Life, Judy Heft.
Hey, everybody. Welcome to Mastering Your Financial Life. And today I'm very excited to be here with Anja Bernier. Anja is the Managing Director of Efficient Evolutions. Excuse me, I read that wrong. Efficient Evolutions. Efficient Evolutions is an experienced company sale and company acquisition advisor to small and medium-sized businesses, individual investors, and private equity firms. She's also a certified business appraiser and certified evaluator. So I'm very excited to have Anja here today. It's going to be a very interesting discussion if you're thinking about selling your business or if you're in that, mindset. So welcome, Anja.
Thank you, Judy, for having me. A pleasure to be here.
Oh, it's my pleasure. So, I think sometimes we don't plan too much in advance, or maybe we wait till the last minute. So how many years before you plan to sell your business did you really start thinking about it? Concretely, not just have a pipe dream like, I'm going to sell in a couple of years and, we'll see what happens. But really, wouldn't you sit down and really pick a date or a time?
Well, it's actually, it requires far more planning than most business owners realize. I'd say ideally the concrete planning should start 3 to 5 years before the sale. 5 years, again, is absolutely ideal. 3 years is certainly very doable. Once you get below 3 years, there's certainly value measures that you will leave on the table because you started too late, quite frankly. My experience is typically, unfortunately, that business sellers contact firms like mine who are in the business of selling companies at a time when they're just sort of had it and are ready to go, which, we can sell the business at the time, but it's very difficult to optimize its value when you start the process at the moment when you really want to sell. So you should really make this a strategic process. And again, start no later than 3 years before you actually want to exit.
So do you recommend someone start with you 3 to 5 years before, or just start planning on their own? Or what do you recommend for people?
I certainly recommend talking to an expert, whether that would be a business appraiser or a mergers and acquisitions advisor, to give some pointers about what is the current value of the company, because it's another thing that some business owners are unrealistic about, because they approach the sale of the company very often with the attitude of how much do I need to retire, forgetting that how much you need is completely irrelevant to the value of the business. Nobody cares, unfortunately, on the buy side that you need an amount X to have a comfortable retirement. And also a lot of business owners expect they get paid for their blood, sweat, and tears. Blood, sweat, and tears in general don't get you any dollars unless the blood, sweat, and tears produced value. And so what I recommend people is talk to an expert who will give you an idea of where you are. The expert can pull some benchmarking data, because that's what we have access to, databases where we can see the average performance of a company in your industry, in your specific industry, and how you compare to them, and can also look at some of the strategic initiatives that would make sense for you, so that you again can use these last few years to really focus on key value drivers and be ready. when the time then actually comes for the sale. So a lot of those measures can be implemented by the business owner themselves, but in my experience, they do often need somebody to tell them what the measures actually are. So I don't consider this a very costly or time-consuming process. You don't have to spend tens of thousands of dollars on outside help. You really need to spend probably a few $1,000s, get that initial analysis, get a list of things you should focus on, and then check in again once you've started implementing them.
Mm-hmm. So what are some examples that people can do, like leading up to the sale of the company? What are some of the things?
Other than
evaluation, talking to somebody, but what are the things that you suggest to people after they come talk to you and they say, you know what, I'm thinking of selling my business. I'm not really ready right now, but I want to put that out there. It's going to be for my future. What are some of the steps that they need to take?
Well, one of the key areas, for example, is customer diversification. It's an issue with a lot of smaller businesses that they, it can be positive and negative. So what's typical for small businesses that they have these long-standing business relationships with clients. And over the years, oftentimes one or two of them have become rather dominant, which is fine if that's a secure relationship with you. What you have to keep in mind is that to a buyer who doesn't have the same type of history with that client, large customer concentration is a huge issue and will decrease the value of your company. Kind of rule of thumb, again, it depends on the industry, but a general rule of thumb is you don't want any customer generating more than 10% of your revenue, and your top 3 customers should not produce more than 25% of your revenue. The more of a spread you have, the better. There's also not just a concentration when it comes to revenue, there's concentration across industry and geographies. I give you an example. After 9/11, the airline industry for a while essentially disappeared. So companies that had clients that were almost exclusively in the airline industry all struggled. So it had like an effect, like a domino effect that went everywhere. And whereas companies that had a diversified industry portfolio, meaning you have some clients in this industry, some in that, are usually less exposed to industry-specific risk. This adds to another factor, which is geography. We live in a global world. Depending on the size of your company and the products you have, it also makes sense that you have geographical diversification. Very few recessions hit the same way worldwide. For example, the Great Recession, yes, it was a worldwide phenomenon, but it didn't hit every country in the same way. So if you have geographical diversification, that also decreases the risk. And there are many ways on how you can achieve customer diversification by, like I said, thinking about it from what can you offer to a new client? How can you get in there? How can you tie them to the company? And again, think about industries, think about geography, but as a key factor, high customer concentrations are the biggest killer of value, really, in most cases.
I guess that makes a lot of sense, because then if there's just a couple of different clients, you don't want to lose them. One could be upset and just say, I'm not going to move with you. And then there you are, the value of your company decreases. So yeah,
absolutely.
That's an interesting point. That makes a lot of sense. So what are some of the other initiatives that a business owner can take?
They're quite, one of the more obvious one, but clearly still something that a lot of business owners overlook is increase profit margins, which goes hand in hand with reducing discretionary earnings. Let's talk about discretionary earnings for a while. It's sort of a bit of a euphemism for the expenses that I would call are not strictly business related, meaning are they really business, or is it that you went to a one-day conference but took your spouse and ended up staying 3 or 4 days and you billed all the hotel and airfare to your business? That's a typical example. Or are you employing your college-age children and pay them a higher hourly rate than you usually would? Are you charging cell phones of family members to the company? The list of examples is long. In cash-strong businesses like bars, restaurants, sometimes not all of the revenue that comes in finds its way on the tax return. So overall, I would like to refer to it as money that the IRS is not aware of. Let's just leave it at that. And by privately held businesses, that is relatively common. Obviously, it's not allowed, but I see it all the time. The issue that you have here is that a buyer will mostly base the value on what you actually reported to the IRS. So if you reported something as an expense, they're going to believe this is a true expense. There will be a certain amount that you can get away with by saying, hey, listen, if you take a closer look, this really was this, that, and the other thing, and it's not strictly business related. But once this gets larger than small amounts, you have a problem. So the buyer will probably not pay you for that kind of lack in profit. Or like I said, if you don't report cash that's actually coming in, the buyer isn't just going to take your word for it. Oh, by the way, there's an extra 50 grand, but I don't usually put that on the tax return. A buyer will be like, well, you know what? How am I supposed to verify that that's actually true? Right. So the way I recommend people look at this, typically small and mid-sized businesses sell for a multiple of 3 to 5 times EBITDA. That's earnings before interest, taxes, depreciation, and amortization. And given that you get, for every dollar that you show on your tax return, $3 to $5 in value, but the tax rate, depending on where you are at, is probably not going to be higher than 40 cents. But just in the last 2 years prior to the sale, getting rid of all the discretionary expenses by reporting everything on your tax return. Let's say you have a 40% tax rate. Let's say you do that for 2 years. For every dollar that you report over the 2 years, you're really losing about 80 cents, assuming it's a 40% tax rate. But you get paid 3 to 5 times by the buyer for showing it. So this is a very basic math of saying it makes financial sense to take the hit on the tax return for a couple of years, because you will more than recoup it. I mean, by a high multiple during the actual sale process. Another thing is, and again, this is one part of increasing your profit margins by taking out these expenses and reporting, obviously, all the revenue. But generally speaking, profit margins tend to be more important to buyers than revenue. What I see often is that a lot of business owners get very focused on revenue and often end up adding very unprofitable revenue to the balance sheet of saying, you know what, I'm doing fine. It's nice. It's a little extra revenue, helps cover the expenses. But if these new contracts that you're adding, diluting your overall profit margin, that reduces the value of the company. So in the years leading up to the sale, you should make sure, if you have salespeople, that you incentivize them specifically for highly profitable contracts and don't base it on revenue. That you really, and that's a mistake a lot of people make, that all the incentives for the sales team is just based on revenue. So they don't really have any reason to chase the more profitable contracts versus the less profitable contracts that give them the same commission. But for you, during the sale of the company, there's a real big difference between contracts that are highly profitable versus not so much. And so again, it's about restructuring your sales efforts, about taking a clear look, go through your clients and really determine which ones are the profitable contracts, which are the not so profitable contracts. What do the profitable contracts have in common versus the not so profitable? Try to find the pattern, and then again, add companies and contracts that fall obviously in the more profitable pattern.
So back to your original comment on this, I think as an entrepreneur, and I've always been an entrepreneur, I've had my business for almost 30 years, we do have a tendency to maybe do some things that aren't, kosher for the IRS. I mean, that's one of the benefits of being an entrepreneur, but you have to keep that in mind when you're getting ready to sell, that maybe that's not the smartest way to do it. But, another question I have for you. So say the last 2 years, someone decides to change their tax return, to make it more profitable, to show more things, some of those things that they weren't declaring, like for instance, a restaurant and a cash type of business. How does that look to the IRS? Will it create an audit flag, a red flag for an audit?
Well, I'm not a CPA, and you should definitely discuss any, tax issue with the CPA, and also any legal issue, obviously, with an attorney. That said, typically, what, in my experience, from what I hear from, because I work with CPAs pretty much every day, that what flags you more for the IRS if your income goes down, not necessarily if your income goes up. Because if you show higher income, they get higher taxes and they are happy. I mean, obviously, my assumption is that the changes aren't crazy. I mean, if my guess is, and again, I'm not a CPA, that if you really hit that much from the IRS, that's certainly something you want to discuss with your CPA. But in most cases, we are not talking that probably your income is suddenly going to go up 50% or something like that. We're talking, probably 10, 15, 20%, if even. And I don't think that's going to, again, flag you for an audit. It's usually the other way around. You go down and the IRS as well. This is kind of odd. We should probably take a look at the expenses that they're reporting and if everything is kosher there. So, but yes, I mean, again, if you deal with a legal matter or tax matter, it's always important to involve a CPA or an attorney. It's another experience I can understand and appreciate, because I'm a small business owner myself, because I own this company, Efficient Evolution. So we all try to, save money and say, do I really need to talk to the attorney about it? It's expensive per hour. Do I really need to contact my CPA about every small issue? But the sale of a company is a big deal. It might be the biggest financial transaction you'll ever do in your life, even exceeding probably the purchase of your house. If not, it probably is similar to it. And typically it's money very well invested to just take a little bit of time of an expert to make sure you're doing it right. This is not the time to basically say, well, you know what, I don't want to talk to my CPA because I'm going to get a bill for $300 for talking to them for an hour, or your attorney, maybe it's then $400, but depending on where you're based. My recommendation is do it, because just an hour of somebody who is experienced will make such a big difference. It's the same with the kind of work that I do. I have sold so many businesses. I've seen so many P&Ls. I've seen so many issues. And that's why I said at the very beginning of our conversation, it's usually not very expensive to get an expert involved a few years ahead of time, because these people tend to be so experienced, including myself. It takes very little time to go through your information and tell you what's needed. That's the advantage of hiring an expert with, a significant amount of experience. It does not take them a long time to come down to what's really crucial for you to implement or keep in mind or to keep an eye on.
Oh, I absolutely 100% agree with you on that. It's always better to call an attorney or a CPA or even hire a bookkeeper, because, that's not your forte. And, that's what we do for our people. And it's always best to hire an expert. I had someone, a lot of people say, well, can I just write my will on LegalZoom? No, that's not a way to do it. That's not smart. So it's not worth the money you're going to save.
No, it's not.
In the long run.
And by the way, I agree on you with the bookkeeping. A buyer will go through your books, whether you run it on QuickBooks or whatever you're using for software. And, like incorrect bookings, just gonna make due diligence more complicated, will drag it out, will cause so many additional questions. You definitely want your books to look good and clean. I've seen it many times. I'm sure you, Judy, you have too. People book because they're, bookkeeping is not their strengths necessarily, unless that's sort of, you're part of your profession. Their book expenses that are really general administrative expenses, they book it under cost of goods sold or vice versa. And then it messes up your reported profit margin if you're being compared to industry benchmarks. It all causes issues, and you should never underestimate issues caused by financials that are not, like I said, in good order and clean.
That makes a lot of sense to me. Let's take a little break now, and we'll be back in a few minutes. We're here with Anja Bernier. So I'm looking forward to hearing more. Thank you, Anja.
Absolutely.
Hey there. I just want to tell you a little bit about my new book that just came out called Mastering Your Financial Life Cycles. And here it is. It's how to successfully manage your money in every decade of life. I co-authored this with my CFO, Liz Levy. And together we created this manual that's going to help you through every stage of life. We talk about having a baby. We talk about young adulthood, pre-retirement, what to do when you're at that age of retirement, if you're contemplating divorce, do you need an estate plan? We cover all of these, each subject in a different chapter. And I really think that you're going to find this so helpful because at the end of every chapter, we have checklists that you can look at and you can use, and they can be a guide for you. So this is a wonderful manual that we've created. It's available on Amazon. You can also find it on our website at judithheft.com/book. And we're here for you. If you need anything, reach out. I hope you enjoy the book. Here's another picture of it, just so you know what's going on. Here it is. And I'm really proud of it. It's my second book. And I'd love to have you read it and give me your feedback. Judy Heft, judithheft.com, financial and lifestyle concierge, celebrating 26 years in business. And over the years, I've learned so much. And what I've been trying to do is impart a little bit of this knowledge to you so I can help all of you become as financially organized as I am.
And we're back with Anja Bernier. Thank you, Anja. So I have a couple. So I want to ask you, so do you work in any industry or are you industry specific? How does that work with you?
I'm not industry specific. Really, the deals that I get involved in are more defined by size. So I specialize in deal values that are between approximately $3 million and $30 million. And I've done industries, anything passenger transportation, manufacturing, web-based. We do a lot in greater real estate related things like new construction, real estate marketing, or construction services. So we have done deals in cannabis, you name it. It's really very, very broad. We're based just outside of Boston, so a little bit of New England. Obviously, it's a lot of high tech too. But we also have clients in Mid-Atlantic, in the Midwest. It's really all over the place. But again, it's more defined by the value of the company, and 3 to 30 million is kind of our sweet spot.
It sounds like you meet a lot of interesting people in all these different industries.
Very much so. Absolutely. I love working with entrepreneurs. They tend to be very interesting people.
Absolutely. So, are there any recommendations that we didn't talk about that can increase the company value, or do you think we covered most of it?
Well,
no cost is good too. Let's talk about that.
Yeah, and little or no cost, that's definitely, again, the list of things that you can do is long. I could talk about this for hours, but focusing on kind of the low-hanging fruit that don't cost a lot. One of the key ones is spread know-how. As we all know, as the founder operator of small businesses, there is a tendency that most of the know-how, in particular the client contacts, are very concentrated in the owner of the company, which is fine for as long as you are there and running it, but it's a huge problem during the sale process, because you may, as a seller, may think of it as like, well, you know what, I'm going to be there during the transition period, I'm going to assist the buyer, so that's not going to be a problem. I can tell you, because I do buy and sell side representation. So sometimes, I'm in the shoes of the buyer, sometimes on the seller. And when I'm on the shoes of the buyer, my initial reply will be, what if you get hit by a bus the day after we close? What if you're saying you're going to be cooperative and supportive during transition period, but then decide you're going to decamp to Florida and be a snowbird, when we need you? So they're not going to take this, I'll just let you know when I'm going to make all the introductions. So the very important thing is, in the years leading up to the sale, if you have key employees that you think are capable, make sure that you spread the know-how and also the customer contact, so that not everybody who calls the company expects to talk to you, but they're very used to speaking to other people, handling their problems. That is going to be a huge factor for a buyer. And another thing which goes kind of hand in hand with spreading know-how is that you want to probably create so-called golden handcuffs for your key employees. And what really golden handcuffs refers to is that it's often advisable to plan to set maybe 5, maybe 10%. It really depends on facts and circumstances what the right number is of the sale proceeds to a fund, and that you contractually reserve this money for your key employees, and that it's structured in the way that they only get these amounts paid out as bonuses if they're still with the firm 12 to 18 months after the transaction closes. If you do something like that, a buyer who recognizes that a lot of the know-how is also tied up in your employees, and that they have a pretty high assurance these employees are not going to leave because they have these bonuses waiting for them, is going to be a huge factor in alleviating the fears of a buyer that once you leave, a lot of the value of the company leaves. There's this saying is that there are many companies out there when the key asset of the company leaves the building when you are entering the elevator in the late afternoon. And you do not want to be in a situation where, if you're honest with yourself, the company would not operate smoothly if you do get hit by a bus tomorrow. Ideally, you want to prepare the company in the years leading up to a sale, to a situation, if something were to happen to you, that the company could operate reasonably well without you.
No, those are great tips. That's really helpful. So yeah, this was really interesting. I love talking to you. I learned so much from you. I wish I had met you a couple of years ago, but no, I learned a lot because I just finished merging my business this week. So, but I'm thinking about all these things that we talked about. I didn't plan early enough. I'll tell you that much. I wish I had, but it all worked out. And, you know, I worked with a good broker, and my attorney was phenomenal, and my accountant, and I had to get a tax attorney and an ERISA attorney, and it all adds up. And of course, it took a lot longer than I had planned on, but it all turned out to be great. You know, being a bookkeeper, having a bookkeeping business, my books were very clean, so that was helpful. Although there were a few things in there. I will say, as an entrepreneur, I did put a few things in there once in a while, but you know, I couldn't help myself on that one. But no, yeah. I think it was good. So yeah, go ahead.
No, I was just saying, I'm very happy for you. Sounds like you had a great transaction. And again, yes, I mean, you can sell any company pretty much at any time. The factor is always value. You know, it's like anything in life, is you can sell any house at any time. It's just the question is, how much are you going to get for it? And so all of what I've been talking about is, if you want to optimize the value of your company and maximize it by maximizing the sale price, again, 3 to 5 years is really the period you should think about. And another thing that a lot of sellers forget is that in most cases, the buyer will insist that you stay on anywhere from 6 months to up to 3 years after the sale. So again, if you think I want to retire to Florida in early 2025, you're already too late. You're not going to be retiring to Florida in early 2025, because again, once you sell the business, typically you need to stay around for a while, which is another reason how we get to these 3 to 5 years to what your own exit planning is for, your own retirement planning. Overall, the key takeaway should be, it takes longer than you think.
Absolutely. I learned that the hard way. The dates kept being pushed out and pushed out and pushed out. And I have a 2-year contract with the new company, so I'm excited about that. And we'll see. Maybe it'll be longer, maybe it won't. But, you know, hopefully they're not going to fire me before the 2 years. But I don't think so.
Yeah, but I'm not surprised to hear that you got the 2-year contract, because again, I'm sure if you would have told them that you want to leave within a month or two after the sale, they would not have paid you what they paid you. Buyers do not want you to disappear right away. And again, that is something you need to factor in when you're planning for when is the right time to sell.
Oh, that's good information. So how can our listeners find you?
Well, I think the easiest way is the website. My company is called Efficient Evolutions. Efficient is not coincidental. I'm originally from Germany, so I love efficiency, obviously. So it's Efficient Evolutions. I also have, obviously, a LinkedIn profile, Anja Bernier. People can also just contact me via LinkedIn. But the website has all the information, but I can also give the phone number, which is the easiest way to reach me at is 617-780-8578. Again, 617-780-8578. And even if I often actually, to be honest, give free advice, which I probably shouldn't. People call me, have a quick question, kind of want to just bounce an idea off, and I'm very open to that. So people shouldn't be worried about, I'm going to get a bill for every call that I make. That's not how it works. Unless I get engaged or the firm gets engaged, obviously it's not going to be a bill and it's not going to be a charge for an initial conversation.
Yeah, that makes a lot of sense. Yeah, we do the same thing. I think it's, we want to help people and give back, and hopefully they turn into a client. And if they don't, that's okay too. You got to give.
Yes,
great.
Absolutely.
That's how it's. Yeah. Thank you so much, Anja. It was a pleasure speaking with you today.
Same here. Thanks, Judy. Bye-bye.
Thank you for tuning into Mastering Your Financial Life, hosted by Judy Heft. You can read chapters of her books and catch prior episodes of the show at www.judithheft.com. Thank you for your positive comments and sharing this show with others.